Booker, a tax manager here at Wegner CPAs. Thank you for joining us today. First, we'll give an overview of the latest stimulus bill, and then we will dive into the details of the employee retention credit. During 2020, we had two major stimulus bills, the Coronavirus Aid, Relief, and Economic Security Act, and the Consolidated Appropriations Act. The CARES Act was signed into law on March 27th. Here's a quick overview of some aspects of the CARES Act for the 2020 tax year. Americans received an advance recovery rebate this past spring that will be trued up on the 2020 tax returns. There was no penalty for coronavirus-related distributions from retirement plans. RMDs were waived for 2020. A new above-the-line deduction was created for charitable contributions up to $300, and the maximum charitable contribution limit was raised from 60% of adjusted gross income to 100% of adjusted gross income. The Consolidated Appropriations Act was signed into law on December 27th. I will refer to this act as CAA throughout today's presentation. The CAA contains numerous provisions that impact payroll, individuals, and businesses. We will start with the individual provisions of CAA. This latest act has provided another round of direct advance payments to Americans. The amounts are a bit different from this spring though. Married couples are eligible for an amount up to $1,200 plus an additional amount of $600 per qualifying child. You may see this advance payment referred to as an economic impact payment. The phase outs are the same as they were for the first payment this spring. Married couples start to phase out at $150,000 of adjusted gross income and fully phase out at $198,000. Individuals start to phase out at $75,000 of adjusted gross income and fully phase out at $99,000 of adjusted gross income. Eligibility for the economic income payment stayed relatively the same from the first round to the second round. This is now the third week into payments being sent out, and you can check the status of the payment at irs.gov using the Economic Impact Payment tool. There was a change made to the $250 above the line deduction for educator expenses. The CAA allows this deduction to include expenses for PPP for educators. So usually educators would have used this for other classroom supplies, but considering the year that it's been, PPP is an expense that's allowed for this deduction now as well. As mentioned earlier, the CARES Act created a new above-the-line deduction for charitable contributions up to $300 in 2020. This amount is the same for single or married filers. The CAA extends this above-the-line deduction through 2021, but modifies the amount to be $600 for married filers. The CARES Act raised the maximum charitable contribution limitation from 60% of adjusted income to 100% of adjusted gross income. For 2020. The CAA extends this change through 2021. The last individual provision we're going to talk about is the temporary change for flex spending plans. An employer may amend their flex spending plans for health and dependent care to allow carryovers of all unused amounts. Previously, the maximum amount a plan could carry over was $550. This means that the amounts from the 2020 plan can be used throughout 2021, and the amounts from the 2021 plan can be used throughout 2022. Again, this is an option by employer and by plan. Now we'll go through some key business provisions from the Consolidated Appropriations Act. The most significant business provision in the Act was the clarity given around PPP expenses. The Act clarified that taxpayers are able to deduct expenses used from PPP loan proceeds that have been forgiven. Also, tax basis will not be reduced as a result of loan forgiveness. This has been an ongoing area of controversy and angst from the very beginning of the payroll protection program. The CAA provides a 100% deduction for the cost of food or beverages provided by a restaurant and paid or incurred in 2021 or 2022. This is a new exception to the general rule that meals are only 50% deductible. All other areas of Section 274 remain the same. But what does this really mean? To try to explain this better, let's remember back to the Tax Cuts and Jobs Act of 2018. TCJA made significant changes to the meals and entertainment deductions. This past October, the IRS issued final regulations related to the meals and entertainment changes from TCJA. The following types of meals were 100%, the following types of meals were 100% deductible before TCJA, after TCJA, and are still 100% after the latest Consolidated Appropriations Act. These are the meal expenses primarily for the benefit of all employees. An example of this would be a holiday party or company cookout. And then food and beverages provided to the general public. An example of this would be an open house. Once again, those are the 100% deductible meal expenses. That was before TCJA, during, and now after CAA. Continuing on with the changes prior to the meals deduction, the 50% deduction for meals expenses looked like this after TCJA. These first two items listed here were 100% prior to that change in 2018. These are the meal expense categories to consider for the new 100% meals deduction from the CAA. The 100% deduction is for the cost of food or beverages provided by a restaurant and paid or incurred in 2021 or 2022. Without further guidance, it is not clear how this 100% deduction will be applied to these categories. So to kind of say another way, all of these categories you can see here are 50% deductible from prior law, from the 2018 TCJA. And that was even after we received final regs this past October. Now with CAA, they're saying meals are 100% deductible if provided by a restaurant. And so we don't know which, if they mean every single one of these 50% categories is 100% as long as it was a restaurant. We just don't really have clear guidance on that right now. There's another area where taxpayers could use some clarity. What is the definition of a restaurant? Does this mean meals from a catering business, for example, do not apply? I thought of a quick local example of this, and that would be sometimes we have meals catered by Hy-Vee. So, I assume they don't consider that maybe a restaurant. So does that mean that doesn't count for the 100% deduction? Also, was this intended to be specific to dining in? We do not think that this was the specific intent. We believe the intent was to generate business for the hard hit restaurants, whether that be in the form of carryout or in-person dining. But, we'll have to wait on further guidance here to have a final answer. So it'll just be important to track these expenses carefully starting this month through 2022. The CAA provided a change to the NOL provisions for farmers. Before the CARES Act, farmers could carry back NOLs 2 years. Then the CARES Act allowed NOLs to be carried back 5 years. The CAA allows farmers that already elected the 2-year carryback to retain that. It also allows farmers who previously waived the carryback election to revoke this waiver, which was previously an irrevocable election. Here's a list of tax extenders from the CAA that are at least through 2021. Some last through 2022, some through 2025, and others were made permanent. The CAA extended the employee's ability to use the FFCRA credits for sick pay and expanded family medical leave pay benefits at an employer's discretion. In other words, employers are no longer required to provide this benefit. The benefit will be an option for employers through March 31st, 2021. No changes were made to the total eligible hours or credit amounts. The FFCRA credits were also extended for self-employed individuals, and the Act allows them to use their reported wages from 2019 instead of 2020 to compute the credit. That's what I have for an overview of the stimulus bill. Now I'm going to hand it over to Dan, who's going to go into the details of the employee retention credit.
Thank you, Whitney. One item here, we did have someone ask a question about explain a little bit further on the tax basis and other attributes of borrower's assets that will not be reduced as a result of loan forgiveness. So that's a little bit of a mouthful, but essentially what that means is whatever loan amount you get forgiven. So let's say you took out a loan for 100,000, that loan gets fully forgiven. That 100,000 then gets reported as other income on an income statement. That income is not subject to tax. You can still deduct all the expenses, and that 100,000 is going to add to a shareholder partner basis. So it is a win-win-win for businesses with regard to the treatment of those PPP loans. So hopefully that answers your question. So the employee retention credit. The employee retention credit, it was part of the CARES Act back in March, and then there were some pretty significant changes made to it, and we'll kind of talk about those a little bit here. So the employee retention credit, it's a payroll tax credit to encourage businesses to retain employees while suffering during the pandemic. So the new stimulus bill extended this beyond 2020 through June 30th of 2021. And the big part of this is it allowed businesses who took out PPP loans to participate in this credit for 2020 retroactively and then prospectively into 2021. Originally, it was an either or. So if you took out a PPP loan, you could not participate in the employee retention credit program. The PPP loan program was so commonly well known and so popular that most businesses use that program. So this really didn't get used that frequently. But as we'll see here, it's a pretty significant credit, and we'll go on to the next slide here and talk a little bit more about it. So in order to be eligible, you must carry on a trade or business and meet one of the two tests listed below. So the first one is a gross receipts test, which we'll talk about a little bit in the next slide. But the other one is one that's got a little more kind of gray area in it, but we have been given kind of some guidance from the IRS on what this kind of means. So for operations that were fully or partially suspended during any calendar quarter in 2020 due to orders from a governmental authority limiting any sort of group meetings, commerce, or travel. So, what does that mean? I have some examples I'll talk about later, but just to kind of get your head in the right frame of thought here. If you're operating a restaurant and your restaurant from the middle of March until June 15th was told you can't have any indoor seating due to the pandemic, you're in for those 3 months. We'll talk a little bit later about kind of what wages qualify, what wages don't qualify. But if you've got a retail store and your retail store had to be closed down because it wasn't considered an essential business, virtually all businesses that were considered non-essential and forced to limit their operations are really going to qualify for this credit. So the gross receipts test, this is different for 2020 versus 2021. It got more favorable in 2021 than it was back in 2020. So there's kind of a couple things to consider here. On this gross receipts test, you're essentially looking at a quarter of 2020 versus 2019. And if your quarter is 50% or less, if it's less than 50% of the gross receipts of the same quarter from the prior year, then you qualify for the credit. Gross receipts is a tax term that's the same as total sales, total revenue, total income, whatever kind of term you want to use. They all kind of mean the same thing. And you stop qualifying in 2020 during the quarter that your gross receipts are over 80% of the same calendar quarter in 2019. So for a lot of businesses, the second quarter of 2020 hit the hardest. And if you were in a scenario where maybe you had 2019 second quarter was 1 million of sales, 2020 second quarter was 400,000 of sales, you're less than 50% and you qualify for this employee retention credit. You stop qualifying again in the quarter where your gross receipts are over 80% of the same quarter in 2019. So let's say you're in the third quarter of 2020, same business. They had $1 million of revenue in 2019. In 2020, they've got 750,000. They're still under that 80% threshold. They still qualify. That business gets into the fourth quarter. They've got 1 million in 2019 for their sales, 1 million in 2020. At that point, they're over that 8% test. So that's the last quarter that they qualify, but they just still would qualify in that fourth quarter. Now, this change in 2020, 2021, again, it gets more beneficial, and this is a significant change. So in 2021, when you're doing this gross receipts test, you're still comparing the quarters. So quarter 1 and quarter 2 of 2021 with the prior year quarters. But you can use the gross receipts from the same quarter in 2020 or 2019. So this is kind of a big deal. If you had a really good quarter in quarter 1 or quarter 2 of 2020 or 2019, and you're at less than 80% of that for your top line income in the first or second quarter of 2021, you're going to qualify. And as we continue on here, I'll kind of get into a little bit more detail of what does that mean when you qualify. So this credit, again, like I talked about earlier, it's a payroll tax credit. So it's going to be handled through payroll tax filings. So the credit is based upon wages. In 2020, for employers that have over 100 full-time employees during 2019, their qualified wages are for wages paid to employees that are not providing services. So essentially, if you have over 100 full-time equivalent employees in 2019, you're only going to get this credit if you're paying people who aren't working. If you've got less than 100 employees during 2019, your qualified wages are wages paid to employees whether they're providing services or not. So the most common scenario you're going to have with this credit is you're paying employees, those employees are providing services for you. If you're over 100 employees, you don't get a credit for the people that you're paying when they're providing services. You only get the credit for people that aren't providing services. If you're under 100 employees, you can get the credit whether or not employees are providing services. So 2021, and this is a change for call them medium-sized businesses where you've got over 100 employees but less than 500. They changed that 100 employee level up to 500, where those qualified wages are to employees whether or not those employees are providing services. So it's really a significant change. I can tell you I was on a phone call with a client last week where they're over 100 employees, but they're under 500. And you know their credit amount that they would have qualified for would have been significant. But in 2020, they didn't pay people who weren't working. And in 2021, you know, their credit for the first and second quarter combined, you know, they're thinking they're going to have enough of a drop in income. They're still going to qualify. Their credit could be well over $1 million in their case. So these numbers do get pretty big for some of these businesses. So as I talk about qualified wages, you know, what are qualified wages? Qualified wages are wages paid to employees. There's a couple exceptions I'll talk about on the next page here, but qualified health plan expenses also qualify. So qualified health plan expenses, that's simply health insurance the employer is paying for the employee. It's not the employee portion that's included as part of the employee's wages. It's the employer portion paid for employees. So when can I start using these qualified wages? For 2020, these are for wages paid after March 12th through December 31st. So anything from March 13th to December 31st, 2020, those are those qualified wages for 2020. But again, kind of keep in mind, you qualify for this on a quarterly basis. So some quarters you might be in, some quarters you might be out. So there's a little more kind of analysis involved. In 2021, it's just kind of straight quarter one and quarter two wages paid. If you qualify in quarter one, those wages qualify. If you qualify in quarter two, those wages qualify. If you qualify in both quarters, you've got quarter one, quarter two payroll tax filings where you're going to take this credit separately. So I'll get in next to a little bit more of a nuance on these credits here. So the 2020 credit is 50% of qualified wages paid to an employee during a quarter from March to December, and it's capped at $10,000 for the year. So the credit, again, is 50% of qualifying wages. The qualifying wages are capped at $10,000. At 50% of that, essentially the credit's capped at $5,000 per employee for the entire year in 2020. So you're not going to get more than $5,000 per employee for this employee retention credit. In 2021, it gets much more generous. And that credit goes from 50% to 70% of qualified wages paid to employees during Q1 and Q2. Again, it's capped at 10,000, but this is a big kind of key difference between 2020 and 2021. This 2021, the credit is on a quarterly basis versus 2020, it's 10,000 for the entire year. So if you kind of think about that, if you had an employee that was paid, we'll just say it's 10,000 in the second, third, and fourth quarter of 2020, they only have 10,000 of wages that qualify for the entire year. In 2021, if you have got that same employee, they're paid 10,000 in the first quarter, 10,000 in the second quarter of 2021. They're going to be at a point where they could have 70% of that 10,000 or $7,000 in the first quarter and in the second quarter for credit. So that credit amount would total 14,000, where the same employee would only have 5,000 in 2020. So this is kind of one of the big questions and the big changes I touched on a little bit earlier. But what if I took out a PPP loan or I used FFCRA credits? How do those kind of interplay with this? The short answer is there's no double dipping. So the new stimulus bill that allows businesses to utilize the employee retention credit even if they took out the PPP loans. However, business cannot use the same wages for the employee retention credit that they're claiming as qualified wages for PPP loan forgiveness. So essentially, if you qualify for this employee retention credit, and we'll say it's the second quarter of 2020, you took out your PPP loan, used that on payroll for all of the second quarter of 2020, submitted your forgiveness application already, you're kind of looking at what payroll did you pay in the second quarter before, really before you took out that PPP loan and got that money that would qualify for this credit. So you can't use the employee retention credit and the FFCRA credits or the work opportunity tax credit either in the same wages. So the FFCRA credits, we touched on those a bit earlier. Those are renewed through March 31st. Work opportunity tax credit, that one also got extended. I think it's through 2025 now. That got extended, and that credit's more applicable for businesses that hire a lot of employees that may have been unemployed for a while. Maybe they were incarcerated coming out of prison, employees who are military veterans, and some other areas. So if you have a business and you haven't heard of the work opportunity tax credit, if you're hiring, we'll say maybe 20 or 30 people on an annual basis, it's something to kind of look into. So what should I do if I took out the PPP loan and I qualify for the employee retention credit? Really, there's just a more strategic approach for submitting forgiveness applications. You want to try to utilize more non-payroll costs, essentially, when submitting your PPP loan forgiveness applications. So another part of this is knowing, what qualifies for the employee retention credit versus what qualifies for PPP. The payroll costs differ between those two. Qualified wages for the employee retention credit is wages paid, caps out at 10,000 annually for 2020, 10,000 per quarter in 2021. And it also counts health insurance paid for those employees. For PPP loans, payroll costs in PPP loans include state and local taxes assessed. So mainly that's state unemployment taxes that are paid through payroll, and then retirement plan costs. So there's a couple costs that qualify for payroll costs in PPP that are not payroll costs for the employee retention credit. So from a kind of strategy standpoint, if you have state unemployment taxes that are being paid, if you have retirement plan costs for employees, where you're matching their 401k or simple IRA, whatever plan your business might have, there's more of an incentive if you qualify for both of these to try to use those state unemployment and retirement plan costs, where there wasn't that incentive before, just a couple weeks ago here. And in addition to that, non-payroll costs are going to be important when running the analysis if you qualify for the employee retention credit and you took out a PPP loan and kind of qualified in those same quarters. So it adds a little bit more analysis to it. I guess I'll share, I've had some examples with clients where it didn't end up mattering because they paid enough wages to employees that they qualified for the employee retention credit fully without even considering the PPP loan. So they already had paid enough wages to their employees after they used up their covered period for their PPP loan. If you're a business that has more so a higher volume of part-time employees, that's where this can really start to factor in and get into some more detailed calculations. So essentially, those the expenses that qualify for the PPP loan forgiveness, if you have the PPP loan and employee retention credit, where you're looking at those wages in the same quarter, there's a little bit more analysis that goes with it. So where do I claim this credit? Where do I ultimately take this credit? Credit's claimed on a Form 941 filing. So if you haven't taken advantage of it in prior quarters in 2020, you can apply for it on your fourth quarter filing. This was a very helpful tip that was added on the bill because we were given this legislation on December 27th. So we obviously can't apply that for the second and third quarter when we just got this new law at the end of the year. So kind of the tip here is look at the analysis and see if you might qualify. Reach out to your tax advisor, and certainly we're all happy to help to see if you might qualify for this, because you'd rather claim it on your fourth quarter payroll tax filing that's due by the end of January than discover that you did qualify, later on in the spring and then amend that payroll tax form to get the money back. You'd rather get it back quicker. So this credit is a refundable credit. So on these 941 forms, there's a line where it says total overpayment. Do you want to apply it forward, or do you want to get a refund check? I'm going to check refund check every time. I want that money. So there's another option here where you can take an advance on the credit. There's a form 7200. Now this form would get filled out. Let's say you're in the first quarter here of 2021, and you just know already you're not going to get to 80% of what your gross receipts were in the quarter of comparing 2019. You're going to qualify for this. You want to take an advance on the credit, you can file that form and receive an advance, and then that gets reconciled when you file your first quarter payroll tax form. There'll be a line item for whatever advance you might have received. So the 2021 credit, again, that's going to be taken separately in the first quarter and the second quarter on the Form 941. Again, those are the quarterly federal payroll tax filings. So, wow, that was a lot of information. So I'm sure many of you are wondering, this is all fine and dandy, Dan. Thanks for all the info. How does it help my business? Let's walk through some examples of how this can really, how businesses can qualify, and then some of the calculations. So first example, we've got a medium-sized business here. They've got 200 full-time employees. They've got 5 million of gross receipts in the second quarter of 2019 and only 2 million in the second quarter of 2020. So if you remember in 2020, this gross receipts test is if you're less than 50% in the same quarter in the prior year. So in this case, they meet that test. So they qualify for the credit based upon the gross receipts test, but only for employees paid for not providing services because they have over 100 full-time employees. So that's one of the catches that we have in this scenario. So we'll look at the next example and see how that's changed in 2021. So example 2 here, that same business, they've got 200 full-time employees. They've got 3.5 million of gross receipts in the second quarter of 2021. If you remember the same example prior, they had 5 million of gross receipts in the second quarter of 2019. So 3.5 million compared to 5 million, that's less than 80% of the 2019 gross receipts. So they qualify for the credit in quarter 2 of 2021 for all employees. This example, in this case, this business has 25 employees. Their gross receipts for the second quarter of 2020 are 900,000. The same quarter in 2019, they were 2 million. Again, they qualify for that employee retention credit For the second quarter, again, remember this gross receipts test for businesses is on a quarterly basis. So you're in 2020 once you're under 50%, and then you're in until once you're 80% or more of the prior year quarter, then you're out after that quarter. So we'll kind of walk through the example here further. So they qualified in the second quarter. In the third quarter of 2020, the gross receipts are 1.5 million. Quarter three of 2019 was 2 million. So they're still less than 80% of those gross receipts, and they still qualify through the third quarter. Then we look at the gross receipts in the fourth quarter. They're 2 million. In 2019 was 1.5 million. So quarter four in this case is the final quarter that the business qualifies. That's the quarter they don't meet that 80% of gross receipts test. So that's the final quarter that they qualify. Just want to make sure that there's an understanding that because they were over that doesn't disqualify for them the entire quarter. That's the last quarter they do qualify for the credit. So similar example here, same number of employees, same gross receipts for the second quarter of 2020, and same number in the second quarter of 2019. They meet this gross receipts test, so they qualify for the credit for the second quarter. Gross receipts in the third quarter are now they're up. They're 2.5 million in 2020 versus 2019 is 2 million. So quarter three in this case is going to be the final quarter that the business is going to qualify. They were over 80% than what they were of the prior year. In this case, they were 125% of what they were in the prior year. And so that's the last quarter they qualify. But before we go to the next slide here, just to kind of get you thinking about this, if your business qualifies in some of these scenarios after you're looking at this, you're starting to wonder, you mentioned earlier that if you took out a PPP loan and used those PPP loan expenses, if you haven't submitted your forgiveness application yet, starting to think a little bit more about, how much should I pay different employees when I got that PPP loan? How do I want to use those wages for employees if I qualify for both of these? Thinking about, well, I better start tracking down my rent or interest I paid on any notes that I had with the bank for mortgage obligations. Looking at utility costs, all those kind of things start playing in a little bit more when kind of doing the analysis for businesses that might have qualified in second and third quarter in 2020, because that was predominantly the time where the PPP money was really being spent. So we're going to get away from numbers here for a couple examples to give your brains a little bit of a break here. So in this case, we've got a restaurant. The restaurant doesn't have a decline in their gross receipts to meet the qualifications for the employee retention credit. But if you remember back to one of the first slides, it was decline in gross receipts or a suspension of some sort of partial suspension of operations. So in this case, the restaurant was ordered to close down their inside seating due to the pandemic. So the restaurant still had carryout orders, they still had outside seating and deliveries, but they did have a partial suspension of their operations, and they did qualify for the employee retention credit under that qualification. Now, let's say this happened in March. 2 months later, it's the middle of May, and they said, okay, you can open up your indoor seating again. The restaurant opens up their indoor seating. They said, well, you can open it up, but tables have to be 6 feet apart and spaced out so they maintain the proper social distancing thresholds. So let's say that restaurant maybe started off with a capacity of, we'll just say 200 people. And now that they've redone their seating and spaced everything out, their capacity is now 100 people indoors. They still qualify for this employee retention credit because the space seating is more than a nominal effect on the business operations. So the IRS hasn't given us a lot of numbers in these regards. The term they keep on using is like a nominal effect on a business. As accountants, we love numbers, we love thresholds, we love, tell us what it is and we'll know how to apply it. And they've really kind of given us a nominal effect on the business operations here. So what we're kind of looking at is more of a theory type idea where if you used to be able to seat 200 people in your restaurant, now you're down to 100, or you could seat 100, now you're down to 50, or maybe you're down to 60 or 70. that's a significant impact on the operations because you can't produce as much revenue and you can't serve as many people because you're really limited as far as the amount of people that are can have capacity to sit at your restaurant. So next example, we'll kind of share a little retail example here. If you have a retail business that's forced to close down their storefront location, but they can still sell products online. Or they'll sell products online. Let's say they're located in a strip mall, and people can still come out and buy items and come pick them up outside or whatever it might be. The retail business operations are partially suspended. The storefront's not open for business. They would qualify for the employee retention credit regardless of a decline in gross receipts. There's certainly scenarios for retailers where maybe they didn't meet that gross receipts decline of 50%, but maybe they had a 30 or 40% drop. They're still going to qualify until the storefront's allowed to be open again. So in this case, these examples just to kind of clarify, if you've got something where you've got a retail store that was forced on March 15th, they had to kind of close their doors to the customers. They could still do online operations and sell products online. And we'll say the middle of June, they were then allowed to have people come back into the storefront. The only wages that qualify are wages paid during March 15th to June 15th. That doesn't mean you could take wages for the rest of the quarter. It doesn't mean that you qualify for the rest of the year. If they happen to meet the gross receipts test, then they can qualify further. But specifically here, this partial suspension of operations is applicable when there's the safer at home order that we had here in Wisconsin. As far as that order is in place where this retail store wasn't allowed to have people in the store, that's where they qualify. Once they're allowed to have people in the store, they stop qualifying again unless they meet that gross receipts test. So this other example here, this is another, we'll call it nominal impact example here. So this is a grocery store. You've got a grocery store and you're required to close your self-serve offerings. So there's a lot of grocery stores where they might have a salad bar, build your own sandwich, whatever it might be, where they've got, trays of food available to kind of mix and match and make whatever you'd like to make. So instead they pre-package and they sell those same salads or sandwiches or whatever it might be. In this case, the business operations are not considered to be partially suspended. It's considered a nominal portion of the business. So I think the theory that the IRS is getting after here is if there's something that happened that's going to significantly reduce your revenue, it's got more than a nominal impact on the business. If there's something where you've got a salad bar and said you prepackage meals and you can still sell them to customers, it's not going to be considered more than a nominal portion of your business because that income has kind of been replaced with another offering. So let's get back into the fun numbers here. So in this case, we've got a business that qualifies for the employee retention credit for the second and third quarter of 2020. Same business takes out a PPP loan. This PPP loan is $200,000 and used over 24 weeks from April through September. In this case, the business has $250,000 of payroll costs, $50,000 of non-payroll costs, qualifying for the loan forgiveness. So this business should use as much of the non-payroll costs as possible to maximize their employee retention credit benefits. So let's kind of take a step back here and talk about this a little bit more. A few weeks ago, if we had these scenarios with clients, we would have just said, well, just take $200,000 of your payroll costs, send that off to your bank. Those are valid expenses. Use that for your PPP loan forgiveness. Now, if we're looking back and, well, you qualify for this employee retention credit for the second and third quarter, those quarters are kind of right when the PPP loan funds were hitting and those were getting utilized. So if this business now has $250,000 of payroll costs and $50,000 of non-payroll costs, we're going to change our tune a little bit now. And we're going to look at, well, let's use as much of these non-payroll costs as possible on your PPP loan forgiveness. Because if we're able to use $50,000 of non-payroll costs in your PPP loan forgiveness, your loan's $200, let's use $150 of payroll costs, $50 of non-payroll. That meets the full threshold you need for the loan forgiveness. And for the PPP loans, you have to use at least 60% on payroll to get them fully forgiven. So in this case, if these numbers are changed around and you've got 200,000 of payroll costs and 100,000 of non-payroll costs, in that case, you're going to want to use up to 40% of non-payroll costs on this loan forgiveness application. You might say, well, why do that? And again, we talked a little bit earlier about, call it the double dipping effect. And what that is if you would have submitted your loan forgiveness for 200,000 here of just payroll costs, your PPP loan can get fully forgiven, but the amount you have qualified for the employee retention credit might just be 50,000. And the credit at 50% of those qualified wages is $25,000, which is nothing to bat an eye over. That's certainly a nice chunk for a credit here. However, if you use those extra 50,000 of non-payroll costs, then you only have 150 of payroll costs that you used for your PPP loan forgiveness. And then you've got an extra 100,000 of payroll costs that qualify for this employee retention credit. And your refundable credit here goes from 25,000 up to 50,000. So it's some real money that we're kind of talking about and looking at these scenarios. And another one that I mentioned earlier, which I'll kind of reiterate, is payroll costs for PPP loans include retirement plan costs for retirement plan matches for employees, as well as state unemployment tax. Those aren't qualifying expenses for the employee retention credit, so those sometimes can come into another kind of analysis and utilizing those as part of payroll costs. So next example 9. This kind of gets into what the credit amount could be depending on different employment levels here. So in this case, you've got a business that qualifies for the employee retention credit for the third and fourth quarter of 2020. The business took out a PPP loan and used all of those funds in the second quarter of 2020. So in this case, there's no interplay. PPP loan expenses were used fully in the second quarter. You've got quarter 3 and quarter 4 of 2020 kind of fully open for this employee retention credit. This business has 10 employees that were paid over 10,000 of qualified wages in quarter 3 and 4 combined, and 6 employees that were paid 5,000 qualified wages in quarter 3 and 4 combined. The employee retention credit calculations as follows. So those 10 employees at that maximum of per employee of 10,000 wages, and then 6 employees with 5,000 of wages. So the total that they have for qualifying wages here is 130,000. Their credit is going to be 50% of those qualified wages, or $65,000. That's claimed on their fourth quarter payroll tax filing here. So that's kind of what it looks like in 2020. And the next slide, I'll kind of touch on what it looks like in 2021 to show how significant the differences really are here. So if the business qualifies for the employee retention credit in quarter 2 and quarter 1 of 2021, same business, 10 employees that were paid over 10,000 of qualified wages. In this case, we're saying these 10,000 of wages are for both quarter 1 and quarter 2. And the 6 employees that were paid 5,000, again, qualified wages in quarter 1 and quarter 2. The employee retention credit calc is as follows here. You've got the same 130,000 qualified wages. And if you remember in 2021, the credit is per quarter. You can have up to 10,000, not for the entire year. And the amount of the credit rises from 50 to 70% of the qualified wages. So in quarter 1, you've got 70% of 130,000, which comes out to 91,000. In the second quarter, you've got the same qualifying wages, that same 70% for the credit. The total credit comes out to $182,000 in 2021 versus $65,000 in 2020. So we're not talking about a huge business here. We're talking a business with 10 full-time employees, 6 part-time employees here at these dollar thresholds. And this credit could be up to $182,000 in 2021. So this is certainly some real money here. So final example, just wanted to kind of show on, a little bit larger scale for some medium-sized businesses, really, how significant this credit can be. So in this case, this business has 200 employees. They meet the qualifications for the gross receipts decline in 2020 and 2021. They don't pay employees who are not providing services. They've got $2 million of wages that are qualified wages during the second to fourth quarter in 2020, but they don't qualify for any credit in 2020 because they're over 100 employees and they're not paying employees who are not providing services. In 2021, the same business has $1.5 million of qualified wages in the first quarter and in the second quarter. Now remember, one of the big differences here between 2021 and 2020 is 2020, when you have over 100 full-time employees. This is based upon 2019 employment levels. You only get the credit for people that you pay for not working. In 2021, that level goes up to 500 full-time employees. So in this business example, they've got 200 employees. 2020, they were out. They didn't pay people who weren't working. 2021, now they qualify. And at $1.5 million of qualified wages in quarter one and quarter two, the credit's computed as follows here. So it's $1.5 million times 70% or $1,050,000 per quarter. So the business has a $2.1 million tax credit for 2021 when you combine the first and second quarter. Now, something to keep in mind, this is an example with a business not taking a PPP loan. There is a second round of PPP loans, and that's going to kind of change some of this analysis as far as these calculations. So these are clean calculations. They're not necessarily real life examples where you got a few more things kind of at play here. But one thing to really keep in mind here is, if you are applying for a second round of PPP loan funds and you do qualify, let's say you get those funds deposited, we'll just say it's going to be maybe the end of next week. It's January 21st, January 22nd, when you get those funds deposited. Before you had that PPP loan, you still had some payroll in the first quarter of 2021 that's going to qualify for this employee retention credit. So you still have some qualified funds there. So here's some of the key takeaways and kind of things to consider. One, do you meet the gross receipts test? Yes or no? These tests are different in 2020 versus 2021. Were business operations partially suspended? Yes or no? If they were partially suspended during 2020, when were they partially suspended? What was that time? How much were you paying people during that period of time? Did you take out a PPP loan round one or round two? If you did, what expenses did you use for forgiveness? Just kind of a takeaway that I kind of want to make sure that is really understood, that this was a really quiet credit program with the first round of PPP loans because it was an either or. Now that you can utilize both. This is significant and really shouldn't be ignored. So if you think you might qualify for this, certainly reach out to us and we're happy to kind of help out and see if you do meet the qualifications to help you, get some refundable money here. So.
Wonderful. That is super helpful information. And Cheryl has just been awesome with all the questions that have been coming in. Dan, if you wanted to take a look at those questions in the Q&A, if there's any general ones that may apply to many people on the call, we can go ahead and get those answered quickly because we do have a little bit of extra time.
Yeah, absolutely. So one question here is, if you permanently laid off an employee to adjust costs, do you qualify? So this employee retention credit, it does not have the same rules that PPP loans have as far as maintaining employment levels. Even if you have reduction in your employment levels, you can still qualify based upon the wages are paid. And non-for-profits do qualify for the employee retention credit as well.
I see one of the questions is, does the credit apply to 501c6 nonprofits or only 501c3? Do you mind clarifying?
I believe the credit's available to both of those. I can follow up and get back on that one.
Perfect.
So I see another question here about the full-time employees determined by 2019 levels for each year. So one thing I guess I want to make sure that everyone is aware of is this new stimulus bill was passed on December 27th. The IRS has not yet updated their Q&A on this employee retention credit. And another thing, kind of from a practitioner standpoint, that might be just kind of helpful for other practitioners maybe who are on the call, is a lot of time when there's new legislation, the IRS issues what are called revenue procedures. The IRS didn't do that at all for this employee retention credit. They really just put kind of a fairly robust Q&A on their website. I'll share that with Emily so she can send that out to others as well. That's really where they answered all of the questions and ran all the scenarios here. So just for all of your information listening on here, that there's likely to be some more guidance issued on this for 2021. So as far as the full-time employees, that's how it's determined for 2020. For 2021, I guess the answer is yes, until we get further guidance. So kind of stay tuned on that one. There's another question about, do employees have to be full-time to qualify? No, you can have part-time employees that qualify for the employee retention credit. They don't have to be full-time. Another question about how many quarters in 2020 you're able to apply for. The question is all that meet the gross receipts decline. So at this point, since there were some changes, if you applied for the credit in the second quarter, or if you applied for it in the third quarter and you apply for all the quarter, your qualified wages are going to be impacted in the fourth quarter. So if you already took part of the 10,000 annual for employee, you can't take 10,000 in each quarter for 2020. That's the maximum per employee. If you did not take it in the second or third quarter, you can take the whole thing on your fourth quarter payroll tax filing. And that entire amount in the fourth quarter payroll tax filing is going to be claimed as a credit. So it doesn't matter if those wages were paid in the second or the third quarter. Let's say you paid 3,000 of wages in the second quarter, 3,000 in the third quarter, 3,000 in the fourth quarter. You're going to claim all those on your fourth quarter filing if you qualified for all of those quarters. And the reason for that is, this stimulus bill was just passed at the end of December here. So employers that took out, I'm going to guess maybe this employer took out a PPP loan and originally they didn't qualify. Now they do. So they can take that credit and take the second, third, and fourth quarter report, all of it on their fourth quarter payroll tax filing, again, if they qualify for all those quarters. So there's one comment on here about being down certain percentages, and I guess I'll maybe touch on that a little bit. If you find that your business didn't qualify for a second round of PPP loan funding, but because you didn't meet the 25% drop in revenue, again, we didn't cover that in this webinar. We've got another webinar on Friday that's digging more into the PPP loans. But if you didn't qualify for a second round of PPP loan funding, you may still meet the gross receipts test to qualify for this employee retention credit. So just be aware that just because you don't qualify for one doesn't mean you don't qualify for the other. In a lot of cases, some businesses are going to qualify for both. So there's a question here about the credit is gross income, not net. Correct. That is correct. This is a gross income test. It doesn't matter what a business's net income is. So your net income could go from a profit to a loss. That doesn't matter for purposes of this credit. For purposes of this credit, they're looking at what is your top line income, not your bottom line. So top line income in 2020 and 2021.
Perfect. And I do see that there's more questions coming in. Some of them are a little bit more in depth, so we'll be happy to follow up after today's presentation via email. Dan mentioned it before, but I just wanted to say it again. We do have another webinar on Friday. So check out our website to see if that's something that you would be interested in, to see if it applies for you and learn a little bit more about all the fun things going on right now. So thank you all so much for attending today. You will receive the recording from today's webinar along with the slides. We so appreciate all of our presenters, all of your helpful information and answering questions and everything. So any last words from our presenters? No?
Thank you, everybody, for listening. Hope you got some good information.
Thank you.
Absolutely. Thank you all for attending, and we will see you soon. Thanks, guys.